So we're back. This is part 2 of learning to invest in the stock market. It's for absolute beginners. We've already done a lot of subjects on different words which are used in the stock market and tips and tricks of investing. So we're going to just carry on with the rest of the video and some new ideas or some new words and expressions. By the way, do you have anything to add?
No.
No. Okay. So we'll go straight into it. Any questions?
Well, just actually, I do have something to add. If you didn't see part 1, go and press on the link below, and you should find it.
That's very useful. Thank you. Off we go. But if you don't know what stocks to pick, or you haven't got the time, an index fund would be a great investment, or an ETF which could or may not track an index. We also have something called mutual funds. In the UK, they call them unit trusts. These are professionally managed funds where you're employing investment managers to try and maximize the income or maximize the growth or maximize both. And the unit trusts might be, or the mutual funds might be focused on a particular country, a particular industry, or a particular investment style. So you might have mutual funds which are invested in Brazilian stocks or Vietnam stocks or India stocks. Some of these markets you can't access directly, so going into one of these funds which specialize in these specialized markets could be a useful way of getting exposure. So those are country mutual funds. You've also got mutual funds which specialize in industries such as technology, such as the pharmaceutical sector, such as commodities, such as the energy sector, and so on. So you can choose a mutual fund which is specialized in a particular area, or you can find mutual funds which are specialized in investment styles. So you might find names like value investing, so or growth. So again, those are two styles. Value investing means buying the cheapest stocks, growth means buying the fastest growing stocks. Or you might find value and growth, which means trying to buy cheap stocks which are growing fast. So all these types of mutual funds are out there, also called unit trusts in the UK, and you can get into those. And lastly, we have in many countries what's called investment companies. These are not exchange traded funds, but they are traded on exchanges. They're not index funds because they don't track indexes, but they are a bit like mutual funds because you have professional, highly paid investment managers who choose the best stocks to put into these investment companies. One such company I talked about a few days ago was the Netherlands company called Proces NV, which is one of the largest internet investing companies, if not the largest internet and artificial intelligence investing companies in the world. But there are many other investment companies around the world. Some of the names which come to mind, and these are none of these are investment recommendations, by the way. There's Investor AB in Sweden, for example. There's Three Eyes, or Investors in Industry, in the UK. Let's see, what have we got in Switzerland? We've got Partners Group. So in Belgium, you've got Sofina SA. And so as we go around the world, you'll find these investment companies which hold lots of companies, and quite often they've done very well. One of the advantages of investment companies is they don't have to hold just quoted stocks. They can hold unquoted stocks. And if they do it well, those unquoted stocks could create special or better opportunities than the stock market, because quite often they've got in on a negotiated basis into the private equity, and that should make a lot more profit. So look out for publicly quoted on the stock market investment companies which give you access to, in a way, can give you access to private equity as well. What are some of the investing strategies you can use? First of all, there's a buy and hold strategy. That is what it says. What do you think buy and hold means?
You buy something and then you hold it.
Yeah, you don't trade it. Yeah, you don't buy and sell it. You just hold it.
To keep it.
And what's the difference between what's a trading strategy?
I don't really know what the trading strategy is.
Okay, so trading strategy is the opposite of buy and hold. You just buy and then you sell when you've got a higher price. So you're aiming to make a profit by buying and selling things. One of my strategies is when I buy something, I try to buy 1/3 of a normal position, 33%, could be a bit more, a bit less, so that I leave some room to buy a bit more. So if the share price goes down, I can buy some more at a slightly lower price and average out my cost. And then if it keeps going down, I can buy another third, the last third, at an even lower price. Or if I bought a third and it goes up, I can buy another third, but even though I bought another third, because I've got the first third at a lower price, I've automatically still got a profit on the whole of the holding, so I can keep buying the last third at an even higher price, and I still have a profit, because no matter what happens, if you're buying at a higher price than your previous purchase, your average price will be higher than what you just paid, which is obviously looks good on paper. And likewise, if it goes down, buying something cheaper than you just paid always seems like a good deal too. So I like to buy one third at a time when I'm buying. And the other trick I like to do is when I'm selling, I do something called top slicing. I never sell an entire position in one go, no matter how overpriced I think it is. What I'll do, I'll top slice. I'll say, oh, I'll sell 20% of the position or 10% of the position, and then I'll see. Now, quite often the share price can continue rising. You don't know if it will, but it might. But at least I've got some of the shares sold at a very large profit. So that's a strategy for exiting. And if I keep a little bit of everything which I've exited, I try not to exit everything completely, because if you sell all your winners, what have you got left? Losers. So you don't want a portfolio of losers. So I try to have as many winners as possible by keeping something of, when I sell my winners, I sell a bit of the holding, then a bit more, then a bit more, but I still keep something behind to keep those winners in the portfolio. That makes a portfolio look really good. It could be useful when you're showing your family, showing your kids, showing your accountant, showing your tax advisor, showing your banker. I mean, who knows who you're going to show your portfolio to? Who knows who's going to look at it, or why, or when? You don't want to be embarrassed by having nothing but losers in your portfolio. So that's why I always keep a little bit of the winning stocks, even if I sold most of them. What's dollar cost averaging? Dollar cost averaging is when you decide to put a certain fixed amount of money into the stock market, or a stock, or an ETF, or a mutual fund, or a unit trust, every month. So every month you put a fixed amount of money, let's say $100 or $1,000 a month, depending what you can afford, and you put it in the stock market, and you're slowly growing and growing your portfolio. The stocks, the prices might be high or they might be low. When they're low, you're buying more stocks. When they're high, you're buying less stocks. But the advantage of dollar cost averaging is, over time, the average price you'll pay for the shares is going to be slightly less than the average price of the stocks over time. And that's because you're buying a lot more shares when the price is low and less shares when it's high. So mathematically, although the average of the prices might be 20, your dollar cost averaging price will be slightly lower than that, because of the mathematics of the way it works. But saving gradually every month works really well, because you quickly, over time, you're building up a growing nest egg, which will become useful when you get older and you want to spend your money on something important, or you want to retire and you need to have a decent amount of money to retire these days. I mean, I think anyone retiring with less than $500,000 will struggle, and in some countries you probably need more than that. We talked about diversification. Obviously, whatever you do, I say diversification, the number of stocks you should have as a minimum is your age minus 20. So if you're 21, and provided that the money's not inherited, it's everything from your own hard work. If you're 21, you could have as little as just one stock if you want. Why? Because if you lose all your money on that one stock, you can make it back and invest in more stocks. It doesn't really matter at the age of 21 if you lose the investment, your first year's savings. I mean, obviously it's going to hurt, but you can take a lot more risk, and you can be a lot more focused in your investment. You can spend a lot more time finding one really, really great investment and go for that. So by the time you're 22, you should have a minimum of 2 investments. But since you already bought one investment in year 1, you can now spend a lot of time on that second investment, and by the time you're 23, you can have a minimum of 3 investments, and so on. So by the time you get to retirement age at, let's say, 65, which is where I retired at 65, you should have a minimum of 45 stocks, provided you're a stock investor. That way, you're protected against the ups and downs of the market as you get older. So the older you get, the more the ups and downs are smoothed out, because you have more stocks, and therefore, you're not swung around by the very rapid movements of just one of them, which is not a good thing if the stocks are going up, but sometimes they go down and you don't want to be part of that. If you've got just two stocks and you're 65 years old and that one of those two goes to nothing. So really, that's why I say the older you get, the more stocks you need to hold. Your age, minus 20, tells you the minimum number. You can hold a lot more. Risk tolerance, I talked about that, and then we're going to finish. So risk tolerance is how much you can stand the fluctuations of the stock market. There are people like me who, and I discovered this in 1987, don't give a toss if the stock markets go down. So in 1987, in October, we had what's called the Black Monday. Stocks went down by 30% in a day. You know what I did? I thought, you know what? I still own them. It was a stock before. It's a stock afterwards. Nothing's changed. I still get the dividends. I discovered I didn't really care. So my risk tolerance turns out to be very high. I can withstand huge fluctuations in the value of my portfolio, provided they're all sound companies, of course. I mean, it wouldn't be the same story if the companies are all going to zero. But if you've got good blue chip companies, they won't go to zero. So, and I'm going to ask you in a minute for some blue chip companies to see if you can think of them. But don't tell me yet.
What's a blue chip company?
They're large, well-run companies, well-known companies, the companies which everybody needs to buy their products and services. So, provided you've got some large, well-run, well-known blue chip companies which are making lots of profits, they won't go to nothing. So, the share price might go down, but you don't mind. The dividend's still the same, might go up. But there are other people who would say, "Oh my gosh, I can't bear the thought of losing 10% of my £1 million fortune. That would be the worst thing in the world. I'd be lost 100,000. That's awful." They've got low risk tolerance. So if you have a low risk tolerance, you shouldn't be in the stock market at all, or maybe only a very little. Now, there's a way to discover what your risk tolerance is if you're a beginner. Only invest a small amount of the money that you've got into your first investments. Then sit back and watch and see how you feel. If the daily fluctuations are making you nervous, you probably have a low risk tolerance and you've invested too much. If the daily fluctuations don't worry you and you're perhaps not even bothered to look every day, well, perhaps you have a high risk tolerance and you can afford to have a higher percentage of your money invested in the stock market. So the amount you have in the stock market, it should never be 100%. I think for many people at a sort of middle of the life period, something like 60% of your money in the stock market is a good number, but then you should have other things like gold or bonds. I'm not saying I like bonds, I definitely don't, or real estate investment trusts. So real estate investment trusts are like exchange traded funds, or investment companies. They're companies which buy lots of properties, and you will receive a share of the rent. In fact, usually you'll receive almost all of the rent. And with many of these as a dividend. So with many of these companies, you'll be earning just as much as you could have got if you'd bought the properties directly yourself. Except now you don't have to do any work. You don't have to put up with any administration. You don't have to deal with accountants. You don't have to deal with tenants. You don't have to deal with repairs and maintenance. You don't have to deal with taxes. You don't have to deal with the notaries or the lawyers when you buy. Everything's dealt with by the real estate investment trust. You just buy one investment and you've got lots and lots of properties in one basket, and you get dividends which are probably very similar to what you would have earned if you'd bought those properties directly. So that's another asset class. So you have shares, that's one asset class. Real estate investment trust, that's another asset class. Bonds, private equity could be an asset class. Gold, silver, platinum, even Bitcoin a little bit. I'm not going to say that you should. People sometimes think I'm a Bitcoin fan because I say you should have some. I'm saying if you like it and you know what it is and you understand it, a little bit won't do any harm. It could improve your Sharpe ratio, but it's a very, very volatile asset, so I don't certainly recommend that anyone goes too deeply into that. And there are other things you could put in your portfolio. Obviously, you should have your own home if you can, and if you like collectibles, if there's something that you're passionate about, whether it be handbags or Chinese dolls or coins, numismatics, that is, by all means, allocate some money to your passion and build up a portfolio like that. Obviously, some people love paintings and works of art, and all of these over time can be great investments, provided you have a skill set and know what you're doing. And you seem to be hiccuping, didn't you? Okay, tell me, said what's a great business? Can you think of any businesses? If you had to find some great businesses, what would you invest in the stock market? Samsung, okay. Apple, yep.
Tractor.
Which one?
Tractor, Caterpillar, I mean.
Okay, yeah, they make tractors, don't they? Caterpillar, yeah.
Nestle.
Nestle.
Netflix.
Yeah, of course. You love watching Netflix, don't you? So some great companies there. If you think of any others, you can let me know.
Wait, what was that called? You did a YouTube video on that one.
Did I? Oh, was that Process the other day or something else? I don't know what. No, you wouldn't know what that is. It doesn't matter. I can't remember what it was now. But you'd invest in companies where you know the name. What about a car company? Can you think of one?
I wouldn't do it.
You wouldn't invest in car companies. Probably very wise. They don't grow much these days. They're probably the market's pretty saturated. So you wouldn't invest in Tesla?
No.
No, I wouldn't invest in Tesla either. But anyway, that's some people love it to death. And if you like Tesla and you think it's got a great future and you think it's the future of robotics and the future of AI, perhaps it's a great investment. I think that it's a little bit expensive for me. The bottom line is, if you don't know what you're doing, invest in these large, well-run, well-known blue-chip companies, the companies that everybody loves, and you'll do very well. And that's the end of this video. So I hope that everybody liked it. I hope that if you stay to the end, you'll want to be a subscriber and hear lots more videos that I'm going to do about different types of, different ways of investing in the stock market, different ways of making profits. I'll sometimes be naming some specific companies which I've invested in and why I've invested in and why I think they're going to go up a lot. And so like, subscribe, and I will reply to all the comments. I'd like to, first of all, on the previous videos, I've had lots of lovely comments. So I'd like to thank all my viewers for those really nice comments. It's the nice comments that encourage me to keep sharing my knowledge and information with others absolutely free of charge. I've got no newsletters to sell. I've got no products to sell. I've got no services to offer. I don't charge anybody. I never need an email address. I don't need any logins. And if you see anyone pretending to be me in the comments or anywhere else, proposing to go on WhatsApp or Telegram, it's not me. I don't do those sort of things. And I certainly won't ask anybody for any money for anything. So like, subscribe and comment. And in the next 7 days, I'll be monitoring the comments and I'll try to reply to as many of them as I possibly can. Probably all of them if you've got a question. Otherwise, I'll just give you a like. So thanks very much, everybody. What would you like to say? Goodbye.
No, it's just that would you show that video of those people jumping off the rock, almost jumping into those sharp rocks?
Yeah, I saw. Yes. What about it?
Can you show it?
Oh, I can add it on. Yes. Okay. We'll add a little video, a surprise video that he suggests I show you of people jumping off the top of a cliff and just missing some sharp rocks. I'll add that right to the end. Thank you very much, everybody, and bye bye now. Like, comment, and subscribe. So, yeah, what do you think? Do you think they're going to jump off into the water or dive off, maybe? But if they hit a rock on the way down, if he slips, he could hit a rock with his head and cut it open, or die, or break his neck.
No, I don't think that.
If you hit a rock on the way down with your head, you become a paraplegic. It means you can never move a muscle in your body ever again.
They're very dumb if they do that.
Look, he's standing like he's going to do it.
Why are they so stupid then?
Well, they're brave, but I wouldn't do it. I don't recommend it. There, he's done it. Oh. He dived a long way away, so he'll be all right. But if one of them doesn't dive so far away, he'll hit the rocks at the bottom.
Oh my goodness.
So he's all right there.
I'm scared. No! I will tell.
Will the others do it or not? I wonder. They're trying to make up their minds. They're probably saying maybe not. He chucked something in the water there.
I think there's his goggles.
Maybe. Oh yeah, he's going to do it too. He's brave enough. I don't recommend this. Because suppose you jump and on the way down and slip, and if you slip you go straight down and there's a rock. There, he's fine. Whoa, belly flop.
I don't think that's belly flop.
That might have hurt. At least it wouldn't have hurt his head. He had to do a belly flop so he doesn't hit the rocks on the bottom, maybe. And the last guy, he's a bit more scared. Oh, he's taking his shoes off. Why is he taking his shoes off? He could throw his shoes in the water, I guess. There we go. Down to his friends. Friends catch his shoes. They go backflip. Oh, that's crazy.
Oh my!
Okay, he'll be fine. He jumped a long way from the edge of the rocks, which is good.